welcome to the debate. So imagine finding a company with near monopoly power in aerospace,
Right.
a flawless balance sheet, and a massive, like 22% return on invested capital. But then, imagine legendary investors like Warren Buffett, Peter Lynch, and Benjamin Graham looking at that exact same company and saying, absolutely not, do not touch it.
Yeah, that is exactly the paradox we are looking at today. I mean, it's the ultimate friction point between a phenomenal underlying business and a completely unforgiving stock price.
Exactly. Today, we are digging into Carpenter Technology Corporation. They are currently priced right around $542.38 per share.
Which gives them a market capitalization of roughly $26.9 billion, right?
Right. And this analysis stems directly from the Ultimate Valuation Gauntlet source material, which really took a microscope to the company's financials. And the central question we have to grapple with is fascinating. Basically, when a company possesses exceptional operational quality and a demonstrably wide economic moat, should investors just tear up the strict historical valuation rulebooks?
Or do extreme valuation multiples and hidden financial red flags signal a stock that is dangerously priced for perfection?
Yeah.
Because it is a high-stakes question. If you get this wrong, you are either missing out on one of the great wealth compounders of our time, or you are about to walk right into a buzzsaw of multiple compression that will absolutely destroy your capital.
Well, when I look at this company, I don't see an overpriced stock. I mean, I see a modern monopoly whose massive, expanding moat completely justifies tearing up those old valuation limits. Carpenter Technology's outstanding capital efficiency, their pristine balance sheet, and their accelerating growth explain exactly why institutional investors are happily ignoring traditional, archaic valuation models.
I hear that. I really do. But excellence in business doesn't excuse you from the laws of math. I look at this exact same data, and I see glaring, fundamental red flags buried in the footnotes.
Red flags?
Yes. My position is anchored in the fact that the frameworks of Benjamin Graham, Peter Lynch, and Warren Buffett all, without exception, definitively reject a $542 price tag. I see deteriorating cash conversion and virtually zero insider confidence, which tells me this stock is severely, mathematically overvalued.
Okay, well, let's lay the groundwork on the quality first, because we really can't talk about the price without understanding what we are actually buying here. Let's look at value creation. Their return on invested capital, their ROIC, sits at an incredible 22.32%.
Right.
And their cost of capital is only 10.5%.
That is a massive spread. I'll give you that.
It is a wealth creation engine. I mean, that means for every dollar they plow back into their specialty mills in Reading or Latrobe, they are generating immense, tangible wealth far above what it costs them to fund that growth.
Sure, but...
And add to that a totally de-risked balance sheet. Their net debt to EBITDA is sitting at just 0.5x. They operate with a 24.08% operating margin, which is best in class for specialty metals. These aren't just solid numbers. They are the hallmarks of a remarkably wide economic moat, built on decades of strict aerospace certifications.
Oh, I won't argue with the moat. The switching costs are astronomically high. If Boeing or Airbus qualifies your specific titanium alloy for a jet engine component, they aren't going to switch suppliers to save a few pennies.
Exactly.
The recertification process takes years.
Right. So Warren Buffett's qualitative checks are decisively met here. The stock's momentum isn't just hype, It is a direct reflection of actual protected value creation. That's why institutional ownership is sitting at 95.5%. The smart money has locked up the float because they recognize an unassailable asset.
That's a compelling narrative, it really is. But let me give you a different perspective. You can buy the greatest company on earth, but if you pay the wrong price for it, it becomes a terrible investment. You mentioned Warren Buffett's qualitative checks?
Yeah.
Well, let's talk about his quantitative checks. Because if we actually apply Buffett's core metric, owner's earnings, to Carpenter Technology, the math falls apart completely.
Walk us through how you're calculating that here.
Gladly. So Buffett uses owner's earnings to figure out how much cash a business actually generates for its owners after keeping the lights on. We calculate it by taking net income, adding back depreciation and amortization, and then subtracting maintenance capital expenditures.
Okay.
When you run that formula for Carpenter, it produces roughly $577 million in owner's earnings.
which is a massive number. I mean, $500 million in true structural cash flow.
It is a large number in a vacuum, but we don't invest in a vacuum. At the current $26.9 billion market cap, that $577 million in owner's earnings gives you a yield of exactly 2.1%.
Ah, the yield.
Yes, the yield. Think about the mechanism here. You are taking on all the equity risk of a highly cyclical aerospace supplier subject to defense budgets and commercial airline cycles for a 2.1% cash yield.
Well,
Wait, you can buy a risk-free 10-year U.S. Treasury bond right now and get roughly double that yield without taking an ounce of equity risk. Buffett is ruthless about opportunity cost. A 2.1% yield is a mathematical non-starter. He would demand a pullback to under $350 a share before he even considered this.
I see why you think that, but isn't waiting for a 40% pullback on a highly certified, vertically integrated aerospace monopoly like waiting for rain in the desert?
I don't think so.
I mean, it might happen, but you're going to die of thirst in the meantime. The reality of modern markets is that wide moat companies operating in secular growth industries do not trade at deep value discounts unless there is a catastrophic macroeconomic event.
But 2.1% is 2.1%. You are drastically overpaying for the cash the business actually generates today.
Today being the operative word. You are looking at the trailing cash yield frozen in time, completely ignoring the trajectory of the business.
Am I?
Yes. We are talking about a company with accelerating revenue growth hitting 8.6% in the current fiscal year, compared to 4.3% the year prior. When you combine an accelerating top line with that 22.32% ROIC, the premium multiple is simply the admission ticket to the moat.
That's a very expensive ticket.
You have to pay up for quality. Buffett himself famously transitioned from buying fair companies at wonderful prices to wonderful companies at fair prices.
I'm sorry, but I just don't buy that. 51 times trailing earnings is not a fair price, even for a wonderful company. We are looking at a trailing PE ratio of 51.6x.
Right?
That is a 23% premium to their own aerospace and defense peers. It is priced for absolute perfection. Any slight delay in the aerospace recovery, any dip in defense contracts, and that multiple will violently compress.
So if Buffett's cash yield requirement naturally pushes us away from high-growth compounders, we have to ask how to properly value that growth trajectory. And I think that leads us directly to the framework of Peter Lynch. Lynch built his entire philosophy around finding growth at a reasonable price.
Yes, he did. And Peter Lynch's metrics utterly destroy the bull case for Carpenter Technology at $542. Let's do the math on Lynch's favorite metric, the PEG ratio, together.
Sure.
The PEG ratio exists to contextualize the PE multiple by factoring in the growth rate. So you take that massive PE of 51.6 and you divide it by their earnings growth rate, which is hovering around 15%.
Okay, so 51.6 divided by 15.
Exactly. And that gives you a PEG ratio of roughly 3.4. Now, Peter Lynch considered a PEG ratio of exactly 1.0 to be fair value. Anything under 1.0 was a bargain. A PEG of 3.4 is astronomical.
Yeah.
It means you are basically paying 3.5 times what the growth is actually worth.
I'm not convinced by that line of reasoning, honestly, mostly because the PEG ratio is an incredibly blunt instrument that inherently struggles with cyclical recoveries.
How so? Math is math.
Because the math lacks context. Carpenter Technology operates in an industry that experiences massive, multi-year cyclicality based on commercial aerospace build rates.
Right.
When you are coming out of a cyclical trough, like the one caused by the pandemic and subsequent supply chain crisis, earnings are temporarily depressed. When earnings are artificially low, the PE ratio looks artificially bloated. You are applying a static PEG ratio to a dynamic margin expansion story.
But we are well past the pandemic trough. Aerospace build rates at Boeing and Airbus have been ramping up for years. The order books are full.
Ramping up theory, yes, but they have been brutally hampered by massive supply chain bottlenecks. They can't get the parts. Carpenter Technology is the bottleneck solver.
Okay.
They make the specialized materials that actually allow those planes to get built. And more importantly, you are ignoring the safety net that pure PEG ratios completely miss.
What safety net? At 51 times earnings, you are walking a tightrope without a net.
The balance sheet liquidity. Look at their current ratio. It's 381. That means they have almost 4 times the liquid assets needed to cover their short-term liabilities. That is a massive liquidity buffer.
Sure. But furthermore, they are actively reducing their share count. Shares outstanding are down 0.59% year over year. The PEG ratio completely ignores the value of a deeply de-risked balance sheet and a shrinking equity base.
A 0.59% reduction in share count is a rounding error when you're trading at 32 times EBITDA. I'm glad they have liquidity, but a current ratio of 3.8 does not justify ignoring a PEG of 3.4.
Well, you are paying 51 times earnings for 15% growth. That is multiple expansion run amok. It's not driven by fundamentals. It's driven by a market indiscriminately chasing aerospace momentum.
But again, you are looking at the price in a vacuum.
Let's not look at it in a vacuum then. Let's look at the absolute foundation of the financials. If you want to talk about safety nets, let's look at the deepest valuation floor there is, Benjamin Graham's defensive frameworks.
Oh boy, all right.
And let's look at the granular accounting reality, because there are red flags buried in the cash flow statements that completely undermine this idea of a flawless operation.
Okay, let's go there. What does Benjamin Graham's defensive math say about a 21st century aerospace manufacturer?
It says the downside risk is terrifying. If we apply Benjamin Graham's strict metrics, the picture gets incredibly dark.
Let's start with the Graham number.
This is a formula Graham designed to blend earnings and book value to find an absolute upper limit for a defensive investor. For Carpenter Technology, the Graham number comes out to roughly $103 per share.
Wow. Wait, $103? So you're saying based on Graham's formula, the stock implies an 80% drop from the current $542 price?
Exactly. The stock is trading at more than 5 times the defensive limit. And it gets worse. Look at his net current asset value, the ultimate liquidation floor.
Right.
You take all current assets, subtract all total liabilities, and divide by the number of shares. That gives us a net current asset value of merely $4 per share.
That is a compelling, shocking number. But have you considered how fundamentally absurd it is to apply Benjamin Graham's liquidation math to this specific company?
Absurd? It's a proven measure of downside risk.
It is the wrong measure for the asset. Graham's models were explicitly designed in the 1930s to find cigar butts, dying companies facing liquidation that had one last puff of value purely in their tangible, physical assets. Applying a Graham's net current asset value to a company with a massive intellectual property moat in additive manufacturing and proprietary metallurgy is like using a thermometer to measure wind speed.
But a price-to-book ratio of 12.1x? The sector average is somewhere between 3 and 5x. You are paying 12 times the accounting value of their assets.
Because the accounting book value does not capture the decades of R&D, the Defense Department certifications, and the switching costs we talked about earlier. Intangible assets and engineering monopolies don't show up on a Graham liquidation spreadsheet. You aren't going to liquidate the intellectual property of a specialized aerospace forge for scrap metal.
I'm not saying they are going bankrupt tomorrow. I am saying the stock is trading entirely on future expectations with zero asset-based margin of safety, and the accounting red flags absolutely back up my concern.
Which are?
Let's look at the actual operations. Inventory turnover has dropped to 2.68x. That is noticeably below their historical averages. In specialty manufacturing, slowing inventory turnover often suggests potential demand softening or a supply chain misalignment.
That's an interesting point, though I would frame that drop in inventory turnover entirely differently. You have to look at the mechanism of how these alloys are made.
Which is what?
It is a massive working capital drag by design. To build complex titanium alloys for a boom in commercial jet engines, Carpenter has to buy massive amounts of raw materials up front. They forge it, they melt it, they cure it. This pipeline is long and highly specialized.
Right.
That isn't demand softening. That is the reality of modern defense and aerospace supply chains, You have to hold material buffers.
Which perfectly explains my biggest red flag. That working capital drag is destroying their cash conversion. They reported $530 million in net income, but only $362 million in actual free cash flow. That is a 68% free cash flow conversion rate.
Because they are funding the inventory build for future growth.
But net income is just an accounting construct. Cash is reality. If that working capital drag continues, they are consuming the very cash they need to justify their valuation. And the people who know this best, the executives running the company, aren't buying the stock.
The insider ownership.
Yes. Insider ownership is sitting at a microscopic 2.43%. The executives who see the order books, the supply chain bottlenecks, and the cash flow statements every single day hold barely more than 2% of the equity. If this aerospace supercycle is as guaranteed as the market thinks, why aren't the insiders eating their own cooking? Why aren't they loading up on shares?
The low insider ownership is a minor footnote when you look at the broader market conviction. Why? Because 95.5% of this company is owned by institutional investors.
Which just means it's a crowded trade fueled by momentum algorithms.
I disagree. It means the smartest, most well-resourced analysts in the world have dissected this company's prospects, and they overwhelmingly want to own it. You are framing standard operational realities like inventory buffering in a complex supply chain as fatal flaws, while completely ignoring that those same operations are generating best-in-class margins.
I'm not ignoring the margins. I am saying the margins are already fully priced into the stock, and then some. Let's look at the ultimate valuation gauntlet summary from the source material. They didn't just look at Graham or Lynch. They ran 21 different rigorous valuation models.
Walk us through what those models actually were.
They ran everything. Discounted cash flow models, dividend discount models, comparables, asset-based pricing, even advanced real options pricing. For example, when you run the actual base case APV, the adjusted present value model.
Wait, before we lose the listener in the acronym soup, APV is essentially valuing the business just on its core operations, and then separately adding in the tax benefits they get from any debt, right? It's a very pure way to look at cash generation. And you're saying that specific model spells trouble?
It spells deep trouble. When you run the APV or the standard unlevered free cash flow models, the weighted average intrinsic value across all 21 models lands in the $310 to $370 range. That implies a 32% to 43% downside from the current $542 price. Even if we throw out the Graham asset-based models that you hate, the comparables average fair value is $230 to $290. They trade at an enterprise value to sales ratio of 8.7x when the sector average is 2 to 3x.
So how do you explain the current price? Just pure irrationality?
The only way you can mathematically justify $542 is by using the most aggressive, optimistic real options models. Models that require near perfect, flawless execution on the aerospace recovery, massive and sustained defense spending increases, and total uninterrupted dominance in additive manufacturing for the next decade. That is the literal definition of priced for perfection, and perfect is very, very hard to execute over a 10-year horizon.
But they are executing. That's the fundamental truth of the asset right now. The 22% ROIC proves they are executing. The 8.6% accelerating revenue growth proves they are executing.
But the deteriorating free cash flow conversion rate of 68% proves that execution is getting more and more expensive to maintain. They are consuming cash to fund that growth. If that working capital drag continues, the 2.1% owner's earnings yield is going to look even worse a year from now.
Clearly establish the battle lines here. Let's synthesize our positions. For me, Carpenter Technology's unmatched operational metrics are the ultimate truth. When a business can sustain a 22% return on invested capital with near zero leverage and operating margins that crush their peers, they are creating immense wealth.
Right.
The expanding economic moat driven by highly protected aerospace certifications, extreme switching costs, and proprietary metallurgy completely justifies a modern valuation paradigm. The historical models of Graham and Lynch simply fail to capture the value of intangible assets, supply chain bottlenecks, and vertically integrated monopolies in today's market.
And to summarize my stance, excellence in manufacturing does not excuse you from the laws of arithmetic. Paying 52 times trailing earnings and 12 times book value for a company with deteriorating cash conversion and virtually zero insider confidence is a recipe for disaster. The unanimous no from the frameworks of Graham, Lynch, and Buffett isn't an accident, and it isn't outdated.
Yeah.
It is a mathematical reality check. The 21 valuation models average out to the mid-300s for a reason.
We do find some common ground, though. We both agree that the underlying business of Carpenter Technology is exceptionally strong.
Oh, absolutely. The economic moat is undeniable, the debt levels are wonderfully low, and their operating margins are deeply impressive. It is a fantastic company operating at a very high level.
It is the fascinating tension of the modern market, a genuinely excellent, high-quality business juxtaposed against a completely unforgiving, sky-high stock price.
The models are clearly pointing south, but the market's momentum is charging north.
Exactly. It's a question of whether the market is accurately pricing a modern, unassailable monopoly or dangerously ignoring age-old investment laws. For those listening, we highly suggest diving deeper into the source material's 21 specific valuation models to dissect the math and the mechanisms for yourselves.
Definitely look at the cash flow statements, look at the working capital drag, and form your own conclusion.
Because at the end of the day, valuing this company is a lot like testing one of their titanium alloys for a jet engine. You can run all the models in the world, but eventually the heat gets turned up and you find out exactly how much stress the valuation can really take.